Good day. In this short video, we will discuss the recording of a transaction where a debtor returns inventory previously sold on credit when a business makes use of the periodic inventory system. The subsidiary journal where the return of all inventory previously sold on credit is recorded is the sales returns journal. Let's have a look at an example. Africa Traders, a registered VAT vendor, buys and sells hand sanitizers. The VAT rate is 15%. All goods are sold at a constant markup of 25% on cost, and the entity uses the periodic inventory system. On 20 August 2024, Mrs. Jones returned inventory to Africa Traders. Mrs. Jones purchased the inventory from Africa Traders on credit for an amount of R4,600 VAT inclusive. Credit note number 345 was issued. We are required to record the transaction provided in the applicable subsidiary journal of Africa Traders. Since a debtor is returning inventory previously sold on credit, this transaction will be recorded in the sales returns journal. The first step is to identify the affected accounts. The first affected account is the trade receivables control account, since the inventory being returned was previously sold on credit to the debtor, and therefore the debtor now no longer owes the business money for the returned inventory. The second affected account is sales returns. The third affected account is VAT output, since the VAT on the original sales transaction was recorded in the VAT output account, and with the return of the inventory, the VAT is reversed. This means that the business no longer needs to pay the VAT on the original sales transaction over to the South African Revenue Services because the inventory was now returned. In the sales returns journal, the full amount owed to the business by the debtor is recorded in the trade receivables control column. This is because the entire amount owed on the returned inventory will now be reversed, or in other words, deducted, and the result will be that the debtor owes R0 on the original sales transaction. The amount recorded in the trade receivables control column is inclusive of VAT, since it is the full amount that the debtor owed to the business. Let's start recording the transaction in the sales returns journal. In the document column, we enter the credit note number 345. The date of the transaction in the day column is entered as the 20th. The debtor details in the details column is Mrs. Jones, since she returned inventory previously sold to her on credit, and in the trade receivables control column, the amount of R4,600. In the sales returns column, we will record the amount exclusive of VAT. With the recording of the original sales transaction, the amount exclusive of VAT was recorded in the sales column, and now with the reversal of the transaction, the amount exclusive of VAT is recorded in the sales returns column. The total amount of the transaction was R4,600. To calculate the VAT exclusive amount, you take the R4,600 divided by 115 multiplied by 100. Therefore, the amount to be recorded in the sales returns column is R4,000. If we now go back to our sales returns journal, we record the R4,000 in the sales returns column. To calculate the amount that should be recorded in the VAT output column, we take the R4,600 divided by 115 multiplied by 15. Therefore, the amount to be recorded in the VAT output column is R600. If we now go back to our sales returns journal, we record the 600 Rand in the VAT output column. After watching this short video, you should now be able to record a transaction where a debtor returns inventory in the sales returns journal of a business, making use of the periodic inventory system. Thank you for watching.